Question 1. Topic: Underwriting process. An insurance company is considering offering a term life insurance policy to a 40-year-old applicant who has a history of high blood pressure. The applicant's health is otherwise stable, and their occupation does not involve any significant hazards. Based on this information, how might the insurance company classify this applicant during the underwriting process? A. Standard risk. B. Substandard risk. C. Preferred risk. D. Decline. Answer: B. Substandard risk. Explanation: the underwriting process evaluates various risk factors to classify applicants into different risk categories. Even though the applicant's occupation and overall health may be stable, the history of high blood pressure is a health condition that could indicate higher potential risk. This applicant is more likely to be classified as a substandard risk because the insurer would expect the possibility of increased medical complications in the future, leading to a higher probability of a claim. Relevant law: under the Fair Credit Reporting Act of CRA, insurers are also required to ensure that the applicant's medical history is accurately assessed, and this can include utilizing resources like the Medical Information Bureau (MIB). Question 2. Scenario-based. Topic: Beneficiaries and settlement options. Mr. Williams owns a term life insurance policy with a death benefit of $500,000. He has designated his wife as the primary beneficiary and his son as the contingent beneficiary. Mr. Williams and his wife tragically pass away in a car accident, and it is unclear who died first. What is the most likely outcome regarding the death benefit distribution? A. The death benefit is paid to Mr. Williams' son as the contingent beneficiary. B. The death benefit is paid to Mr. Williams' estate. C. The death benefit is split between Mr. Williams' wife's estate and his son. D. The death benefit is forfeited. Answer: A. The death benefit is paid to Mr. Williams' son as the contingent beneficiary. Explanation: in this situation, the common disaster clause typically applies. This clause ensures that if both the insured, Mr. Williams, and the primary beneficiary, his wife, die in a common disaster and it is impossible to determine who passed away first, the insurance company will proceed as though the primary beneficiary predeceased the insured. Thus, the contingent beneficiary, in this case Mr. Williams' son, would receive the death benefit. Relevant law: the North Dakota specific regulations regarding the simultaneous death clause guide the payment in cases where the order of death is unclear. Question 3. Topic: Premiums and pricing. When calculating the premium for a term life insurance policy, which of the following factors would not directly influence the premium pricing? A. The insured's age. B. The insured's gender. C. The company's administrative expenses. D. The insured's state of residence. Answer: D. The insured's state of residence. Explanation: premiums for term life insurance policies are based on factors such as the insured's age, gender, and health status, all of which affect the mortality risk. Additionally, insurers consider administrative expenses and profit margins. However, the insured's state of residence does not typically influence the premium directly, although state regulations can affect the product offerings and overall policy terms. Mortality tables, which guide insurers in predicting life expectancy, do not differentiate based on location unless specific regional health trends are considered. Relevant rule: the law of large numbers helps insurers predict losses across large populations considering individual risk factors, but not generally distinguishing by geographic location for term life insurance premiums. Question 4. Topic: Policy riders and endorsements. Which of the following riders allows an insured person to purchase additional life insurance coverage in the future without providing evidence of insurability? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Accelerated death benefit rider. Answer: C. Guaranteed insurability rider. Explanation: the guaranteed insurability rider allows the policyholder to purchase additional life insurance at specific future dates or life events without having to prove insurability, i.e., no additional medical exams required. This rider is valuable because it allows the insured to increase coverage as their life circumstances change, such as having children or purchasing a home, regardless of any changes to their health. The other riders do not provide this benefit. Relevant law: North Dakota insurance regulations ensure that riders must be clearly explained to policyholders during the application process, and suitability is key in determining whether riders are beneficial for the client's long-term needs. Question 5. Topic: Beneficiaries and settlement options. Which of the following settlement options allows the beneficiary to receive equal periodic payments from the death benefit until the entire amount is exhausted? A. Interest only. B. Lump sum. C. Fixed amount. D. Life income. Answer: C. Fixed amount. Explanation: under the fixed amount settlement option, the insurance company pays a set amount of money to the beneficiary at regular intervals, monthly, quarterly, or annually, until the full death benefit is paid out. This is different from the interest-only option, where the death benefit is left with the insurer and the beneficiary only receives interest payments, and the lump sum option, where the entire death benefit is paid at once. Relevant regulation: according to North Dakota law, insurers must provide clear information on settlement options to beneficiaries and allow them to make an informed choice that fits their financial needs. Question 6. Scenario-based. Topic: term life insurance policy provisions. Mrs. Johnson owns a 20-year level term life insurance policy with a face amount of $250,000. She recently found out that due to financial hardship she could not pay the premiums on time. Which provision of the policy could help her avoid losing coverage due to a missed premium payment, A. Incontestability clause, B. Misstatement of age provision, C. Grace period provision, D. Conversion privilege? Answer: C. Grace period provision. Explanation: the grace period provision allows policyholders extra time, typically 3031 days, to pay overdue premiums without causing the policy to lapse. During this period, the policy remains in force. If the policyholder dies within the grace period, the death benefit is still paid, minus the unpaid premium. Relevant law: in North Dakota, life insurance policies are required to include a grace period for the payment of premiums to provide policyholders with flexibility during financial hardships. Question 7. Topic: contract law. Which of the following correctly describes a contract that has not yet been legally enforced but can become enforceable upon meeting certain conditions? A. Void contract, B. Unilateral contract, C. Conditional contract, D. Aleatory contract? Answer: C. Conditional contract. Explanation: a conditional contract is one that becomes enforceable only when certain conditions or events occur. In life insurance, for example, a policy is considered a conditional contract because the death benefit is payable only upon the death of the insured. This contrasts with a void contract, which is invalid from the start, and an aleatory contract, which involves an unequal exchange of value. Relevant law: in North Dakota, all life insurance policies are considered conditional contracts because payment is contingent on the occurrence of a specific event, the death of the insured. Question 8. Topic: North Dakota specific insurance laws. Under North Dakota insurance law, how long is the free look period during which a policyholder can review and return a term life insurance policy for a full refund? A. 10 days, B. 15 days, C. 30 days, D. 45 days? Answer: 10 days. Explanation: the free look period in North Dakota allows a policyholder to review the terms of the life insurance policy after receiving it. If the policyholder is not satisfied, they can cancel the policy within 10 days of delivery and receive a full refund of any premiums paid. This period is intended to give the insured time to ensure the policy meets their needs. Relevant law: North Dakota insurance law mandates a minimum 10-day free look period for all life insurance policies, including term life insurance, to protect consumers and allow for informed decision-making. Question 9. Topic: claims and payment of benefits. If an insured individual misstated their age on the application for a term life insurance policy and passed away, what action will the insurance company take when processing the claim? A. Deny the claim entirely due to misrepresentation. B. Pay the full face amount of the policy. C. Adjust the death benefit to reflect the correct age. D. Refund the premiums paid without paying the death benefit. Answer: C. Adjust the death benefit to reflect the correct age. Explanation: if an insured misstated their age, the insurer will not deny the claim outright. Instead, the misstatement of age provision allows the insurer to adjust the death benefit to reflect what the premium would have purchased at the correct age. For example, if the insured was older than stated, the death benefit would be reduced. This protects the insurer from losses due to incorrect information while still providing some benefit to the beneficiary. Relevant law: North Dakota life insurance policies must include a provision for the adjustment of benefits in cases of misstatement of age or sex. Question 10. Topic: policy riders and endorsements. Which rider is commonly added to a term life insurance policy to provide an additional benefit if the insured dies in an accident? A. Waiver of premium rider, B. Guaranteed insurability rider, C. Accidental death benefit rider, D. Accelerated death benefit rider? Answer: See accidental death benefit rider. Explanation: the accidental death benefit rider, often called a double indemnity rider, provides an additional payout if the insured dies as a result of an accident, typically doubling the face value of the policy. This rider is commonly added to term life policies for individuals who want additional protection in the event of an accidental death. The other riders, such as the waiver of premium rider, serve different purposes, like waiving premiums if the insured becomes disabled. A relevant law. North Dakota law requires insurers to clearly explain the terms and costs associated with riders to ensure the policyholder understands their options. Question 11. Topic: Types of life insurance policies. Which of the following life insurance policies provides a death benefit and builds cash value, allowing the policyholder to borrow against it or use it as collateral for a loan? A. Term life insurance. B. Whole life insurance. C. Variable life insurance. D. Universal life insurance. Answer: B. Whole life insurance. Explanation: whole life insurance provides a guaranteed death benefit along with a cash value component that grows over time. Policyholders can borrow against the cash value or use it as collateral for loans. This distinguishes it from term life insurance, which only offers a death benefit without cash value. Variable life insurance and universal life insurance also build cash value, but differ in flexibility and investment options. Relevant law. North Dakota law mandates that policyholders be informed of their ability to access the cash value and the implications of borrowing against it. Question 12. Topic: Policy provisions. Which provision allows a life insurance policy to remain in force for a limited time after the premium due date has passed? A. Reinstatement provision. B. Grace period provision. C. Incontestability clause. D. Free look period. Answer: B. Grace period provision. Explanation: the grace period provision gives the policyholder extra time to pay overdue premiums, usually 3031 days, without the policy lapsing. If the policyholder passes away during the grace period, the insurer will still pay the death benefit, but the overdue premium may be deducted. This provision provides flexibility and prevents immediate policy cancellation due to a late payment. Relevant law. In North Dakota, insurers must provide a minimum grace period for all life insurance policies, ensuring coverage is not lost due to short-term financial difficulties. Question 13. Topic: Policy loans. When a policyholder borrows against the cash value of their whole life insurance policy, what happens if the loan is not repaid before the policyholder's death? A. The loan is forgiven and the death benefit is paid in full. B. The loan is subtracted from the death benefit. C. The loan must be repaid by the beneficiary. D. The policy is cancelled. Answer: B. The loan is subtracted from the death benefit. Explanation: if a policyholder takes a loan against the cash value of a whole life policy and does not repay it, the outstanding loan amount, including interest, is deducted from the death benefit. This ensures that the insurer recovers the loan amount, but the beneficiaries receive a reduced payout. Relevant law. North Dakota law requires insurers to disclose the impact of policy loans on the death benefit to policyholders clearly. Question 14. Topic: Life insurance premiums. What happens to the premium of a renewable term life insurance policy at the end of the policy term? A. The premium remains the same. B. The premium decreases. C. The premium increases. D. The policy cannot be renewed. Answer: C. The premium increases. Explanation: with a renewable term life insurance policy, the policyholder has the option to renew the policy at the end of the term without proving insurability. However, the premium increases because it is based on the insured's age at the time of renewal. This allows continued coverage, but at a higher cost as the risk to the insurer increases with age. Relevant law. North Dakota law mandates that the terms of renewable policies, including the premium increase, must be clearly outlined in the policy documents. Question 15. Topic: Beneficiaries. If the primary beneficiary of a life insurance policy predeceases the insured, who typically receives the death benefit? A. The state. B. The insurer. C. The contingent beneficiary. D. The insured's employer. Answer: C. The contingent beneficiary. Explanation: if the primary beneficiary is no longer alive when the insured passes away, the death benefit is paid to the contingent beneficiary, who is the next in line to receive the proceeds. If no contingent beneficiary is named, the death benefit typically goes to the insured's estate. Relevant law. North Dakota insurance regulations require that life insurance policyholders clearly designate both primary and contingent beneficiaries to avoid disputes and ensure the proper distribution of death benefits. Question 16. Topic: Life insurance riders. Which rider waives premium payments if the policyholder becomes totally disabled and unable to work? A. Accidental death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Accelerated death benefit rider. Answer: B. Waiver of premium rider. Explanation: the waiver of premium rider ensures that the policyholder does not have to pay premiums if they become totally disabled and are unable to work. This keeps the policy in force without requiring additional payments, providing peace of mind in case of disability. Relevant law. North Dakota insurance laws ensure that the terms of riders, including the conditions under which premiums are waived, are clearly explained to policyholders. Question 17. Scenario-based. Topic: Policy reinstatement. Mr. Smith's life insurance policy lapsed after he missed several premium payments. 6 months later, he is able to pay the overdue premiums and wants to reinstate the policy. What provision might allow him to do so? A. Incontestability clause. B. Grace period. C. Reinstatement provision. D. Misstatement of age provision. Answer: C. Reinstatement provision. Explanation: the reinstatement provision allows the policyholder to reactivate a lapsed policy by paying back overdue premiums with interest and providing evidence of insurability if required. This is beneficial because it allows the policyholder to restore the original policy terms without needing to purchase a new policy. Relevant law. In North Dakota, insurers must offer a reinstatement period, typically up to 3 years, during which lapsed policies can be reinstated under specific conditions. Question 18. Topic: Types of policies. Which type of life insurance policy allows the policyholder to adjust both the premium payments and the face amount of coverage? A. Whole life insurance. B. Universal life insurance. C. Term life insurance. D. Variable life insurance. Answer: B. Universal life insurance. Explanation: universal life insurance offers flexibility in both premium payments and death benefit amounts. The policyholder can adjust the coverage or payment amount as needed, provided there is enough cash value to support the changes. This flexibility makes it a popular option for those who may need to change their coverage or premium payments over time. Relevant law. North Dakota law requires insurers to provide clear and detailed information on the adjustable features of universal life policies. Question 19. Topic: Tax treatment of life insurance. Which of the following best describes the tax treatment of life insurance death benefits? A. Death benefits are always taxed as income to the beneficiary. B. Death benefits are subject to federal income tax. C. Death benefits are generally not subject to income tax. D. Death benefits are taxed only if they exceed $500,000. Answer: C. Death benefits are generally not subject to income tax. Explanation: in most cases, life insurance death benefits are not considered taxable income for the beneficiary. However, any interest earned on the death benefit, if paid out over time, may be subject to income tax. This tax advantage is one of the reasons life insurance is a popular estate planning tool. Relevant law. North Dakota follows federal guidelines regarding the tax treatment of life insurance death benefits, ensuring that beneficiaries receive the full amount without income tax liability. Question 20. Topic: North Dakota specific regulations. In North Dakota, life insurance policies must include which of the following provisions to protect consumers? A. A minimum 10-day free look period. B. A maximum contestability period of 5 years. C. Mandatory accidental death coverage. D. Waiver of premium for all policies. Answer: A. A minimum 10-day free look period. Explanation: North Dakota law mandates a minimum 10-day free look period during which policyholders can review the policy and cancel it for a full refund if they are not satisfied. This protects consumers by giving them time to ensure that the policy meets their needs before committing. Relevant law. The North Dakota Insurance Code requires life insurance policies to include this provision to enhance consumer protection. Question 21. Topic: Policy exclusions. Which of the following is a common exclusion in life insurance policies, meaning the insurer may not pay the death benefit under these circumstances? A. Death due to natural causes. B. Death while committing a crime. C. Death from a terminal illness. D. Death from an accidental injury. Answer: B. Death while committing a crime. Explanation: life insurance policies often include exclusions for certain types of deaths, such as those that occur while the insured is committing a crime. This prevents beneficiaries from claiming death benefits if the insured dies as a result of illegal activity. Other common exclusions may include suicide within a specific period, war, and acts of terrorism. Relevant law: North Dakota law allows insurers to exclude coverage under specific circumstances, provided these exclusions are clearly outlined in the policy. Question 22. Topic: Life insurance riders. Which rider allows the policyholder to purchase additional life insurance coverage at specified intervals without providing proof of insurability? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit rider. D. Accelerated death benefit rider. Answer: B. Guaranteed insurability rider. Explanation: the guaranteed insurability rider allows the policyholder to buy additional life insurance at specific times. G. After a certain number of years or following life events like marriage, without having to undergo a medical exam or provide evidence of good health. This is beneficial for individuals who anticipate needing more coverage as they age or their circumstances change. Relevant law: North Dakota law ensures that life insurance policies with this rider must clearly explain the conditions under which additional coverage can be purchased. Question 23. Topic: Annuities. Which type of annuity begins payments immediately after a lump sum premium is paid? A. Deferred annuity. B. Immediate annuity. C. Variable annuity. D. Fixed annuity. Answer: B. Immediate annuity. Explanation: an immediate annuity starts making payments to the annuitant right after a lump sum premium is paid. This type of annuity is often used by retirees looking for a reliable income stream. It contrasts with a deferred annuity, which accumulates value over time before payments begin. Relevant law: in North Dakota, annuities must clearly specify when payments will begin and under what terms the annuitant receives their income. Question 24. Topic: Tax treatment of life insurance. What is the tax treatment of premiums paid for individual life insurance policies? A. Premiums are tax deductible for the policyholder. B. Premiums are not tax deductible for the policyholder. C. Premiums are tax deductible for the policyholder if they itemize deductions. D. Premiums are tax deductible only if the policyholder is over 65. Answer: B. Premiums are not tax deductible for the policyholder. Explanation: premiums paid for individual life insurance policies are generally not tax deductible. Life insurance is considered a personal expense and the IRS does not allow deductions for such costs. However, the death benefit is usually received tax-free by the beneficiaries. Relevant law: North Dakota follows federal tax guidelines, which do not allow life insurance premiums to be deducted on individual tax returns. Question 25. Topic: Group life insurance. Which of the following statements about group life insurance is true? A. Group life insurance always provides whole life coverage. B. Premiums for group life insurance are usually higher than individual policies. C. Group life insurance is often offered through an employer. D. Group life insurance policies do not allow beneficiaries to be named. Answer: C. Group life insurance is often offered through an employer. Explanation: group life insurance is typically offered as a benefit by employers to their employees. It is usually term life insurance, which means coverage lasts for a specified period, such as the duration of employment. Premiums for group life insurance are often lower than individual policies due to the risk being spread across many individuals. Beneficiaries can be named in group policies just like individual policies. Relevant law: North Dakota law regulates group life insurance policies, ensuring that employees are informed of their rights and coverage options. Question 26. Topic: Life insurance policy provisions. Which provision in a life insurance policy allows the policyholder to change beneficiaries at any time? A. Entire contract provision. B. Reinstatement provision. C. Incontestability clause. D. Revocable beneficiary provision. Answer: D. Revocable beneficiary provision. Explanation: a revocable beneficiary provision allows the policyholder to change the named beneficiary without the beneficiary's consent. In contrast, an irrevocable beneficiary cannot be changed without the consent of the beneficiary. Most life insurance policies designate beneficiaries as revocable unless specified otherwise. Relevant law: North Dakota insurance regulations allow for beneficiary designations to be either revocable or irrevocable depending on the policyholder's choice. Question 27. Topic: Beneficiary designations. Which of the following occurs if no beneficiary is designated in a life insurance policy? A. The policy automatically lapses. B. The death benefit is paid to the insured's estate. C. The insurer keeps the death benefit. D. The death benefit is donated to charity. Answer: B. The death benefit is paid to the insured's estate. Explanation: if a life insurance policy has no designated beneficiary or the named beneficiary is deceased and no contingent beneficiary is named, the death benefit will be paid to the insured's estate. This can lead to complications, such as the death benefit being subject to probate, potentially delaying the distribution of funds to heirs. Relevant law. North Dakota law stipulates that life insurance proceeds without a beneficiary revert to the insured's estate. Question 20. Topic: Replacement of life insurance. When replacing an existing life insurance policy, what must the agent do to comply with regulations? A. Inform the insurer only after the replacement is complete. B. Provide a replacement notice to the policyholder and obtain their signature. C. Keep the replacement process confidential. D. Cancel the old policy without notifying the policyholder. Answer: B. Provide a replacement notice to the policyholder and obtain their signature. Explanation: in a life insurance replacement situation, the agent must provide a replacement notice to the policyholder outlining the advantages and disadvantages of replacing the existing policy. The policyholder must sign the notice acknowledging that they understand the consequences of the replacement. Relevant law. North Dakota law regulates life insurance replacements to protect consumers from losing benefits or facing financial disadvantages without proper disclosure. Question 29. Topic: Life insurance and divorce. In North Dakota, what happens to a life insurance beneficiary designation if the insured gets divorced? A. The beneficiary designation automatically changes. B. The beneficiary designation remains unchanged. C. The policy is cancelled. D. The court determines the new beneficiary. Answer: A. The beneficiary designation automatically changes. Explanation: in North Dakota, after divorce, the former spouse is automatically removed as a life insurance beneficiary unless the policyholder expressly indicates otherwise in writing. This is intended to prevent unintended payouts to ex-spouses. Relevant law. North Dakota law provides for automatic revocation of ex-spouses as beneficiaries in life insurance policies following a divorce. Question 30. Topic: Incontestability clause. How long does the incontestability period typically last for life insurance policies in North Dakota? A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. 2 years. Explanation: the incontestability clause in life insurance policies typically lasts for 2 years. During this period, the insurer can contest the validity of the policy based on material misrepresentations made by the policyholder. After 2 years, the policy becomes incontestable except for cases of fraud. Relevant law. North Dakota mandates a 2-year incontestability period in life insurance policies, providing consumers with a sense of security after this period passes.